In most countries, investors know the name of their benchmark rate: the Fed funds rate in the US, the Euribor in Europe, or the LIBOR in the UK. But in Brazil, there's one index that drives the entire financial market, from savings accounts to billion-dollar bond issuances. It is called the CDI, and understanding it's the key to understanding how Brazil's fixed income really works. Today, I'll explain what the CDI is, why it is considered one of the safest benchmarks in emerging markets, and how global investors can use it to capture Brazil's high real yields. CDI stands for Certificado de Depósito Interbancário, or Interbank Deposit Certificate. It is the average interest rate charged between banks for short-term loans, typically overnight. Every business day, Brazilian banks lend and borrow money from each other to balance their accounts. The rate applied in these transactions becomes the CDI rate, a benchmark that mirrors the Selic, Brazil's official monetary policy rate, set by the central bank. In practice, the CDI is what keeps the Brazilian financial system liquid and connected. It's like the bloodstream that ensures money keeps flowing efficiently between institutions. Many investors confuse this with the Selic rate. They are indeed close, but not identical. The Selic is the policy rate, while the CDI is the market rate that banks actually use for daily transactions. Historically, the CDI tracks almost identically to the Selic, usually just a few basis points lower, meaning that investments tied to the CDI practically follow Brazil's benchmark interest rate in real time. When the central bank raises or cuts the Selic, the CDI moves right along with it. The CDI is the foundation for nearly all fixed income products in Brazil, such as CDBs, which are bank deposits, LCIs and LCAs, which are real estate and agribusiness credit, corporate bonds, investment funds. All of these typically express their yield as a percentage of the CDI rate. For example, 110% of the CDI or 95% of the CDI. That means if the current CDI is 15% per year, an investment paying 110% of the CDI would yield around 16.5% annually before taxes. It's a simple and transparent way to benchmark returns, allowing investors to immediately understand how competitive a given rate really is. One of the main reasons global investors are drawn to the CDI-linked assets is their institutional safety. The CDI itself is calculated and published daily by B3, the Brazilian Stock Exchange, under the oversight of the central bank and the CVM, which is Brazil's equivalent of the SEC. And when you invest in a CDI-based instrument like a CDB, your money is backed by regulated financial institutions, often among the most solid in Latin America, such as BTG Pactual, Itaú, or Bradesco. Additionally, for individuals, most CDBs and LCIs are protected by the Credit Guarantee Fund, the FGC, which ensures deposits up to 250,000 reais per institution, similar to the FDIC in the United States. Now, here's where it gets interesting for international investors. With the current Selic rate around 15% per year, CDI-linked investments deliver double-digit returns in a market that's both liquid and institutionally robust. Even after accounting for inflation, real returns remain among the highest globally. For example, in the US, real yields on treasury bonds are around 2%. In Europe, close to 1%. In Brazil, CDI-linked investments can deliver 9 to 10% real yield, depending on inflation. And because the Brazilian government and financial institutions have a strong regulatory track record, these returns come with risk-adjusted stability, rarely found in other emerging markets. Through the CNR account, foreign investors can directly access CDI-linked products issued by banks and regulated financial institutions. Whether through the Tesouro Direto platform or through private fixed income products offered by institutions like BTG Pactual, investors can build a portfolio fully benchmarked to CDI. And for those who qualify as non-residents under Brazilian law, the tax advantages can be significant, including zero income tax on government securities. This makes CDI-based strategies a powerful way to combine high yield, legal protection, and full liquidity in the Brazilian market. So, when you see the term CDI in Brazilian investments, think of it as the heartbeat of the entire system. It reflects the country's interest rate policy, provides a transparent yield benchmark, and supports some of the most profitable fixed income strategies available to global investors today. If you're building an international portfolio and looking for yield, liquidity, and institutional strength, the CDI is where your Brazilian investment story begins. To understand how to invest in CDI-based instruments through your CNR account, subscribe to the channel and follow our upcoming videos. Let's explore Brazil together.